$210 million. That's what it costs to build a modern regional shopping mall. But here's the question that keeps investors awake at night. When will they see their first real profit? The answer might shock you. Today we're diving deep into the economics of mall ownership, and what we discovered will change how you think about these massive investments forever. Let's put this number into perspective. $210 million is more than the GDP of some small countries. It's enough to buy 420 average American homes or fund a small city's entire annual budget. But for mall developers, this is just the entry fee into one of the most complex investment games in real estate. Here's what most people don't realize about shopping malls. The initial construction cost is just the beginning. We're talking about a 250,000 square foot regional mall with 4 anchor stores, the kind you see in major suburban areas across America. Construction alone averages $350 to $650 per square foot for super regional malls. But wait, there's more. Land acquisition can add another $20 to $50 million depending on location. Permits and licensing fees range from $50,000 to $200,000. Then you have the architect fees, which can hit 19% of total construction costs. That's another $40 million right there. The real kicker? Before a single customer walks through those doors, developers are already spending millions on marketing, pre-leasing campaigns to secure anchor tenants. Because here's the thing about malls. Without anchor stores like Macy's, Nordstrom, or Target, you don't have a mall. You have an expensive, empty building. These anchor stores are the traffic magnets. They negotiate the best deals, sometimes paying as little as $8 to $12 per square foot annually. Meanwhile, smaller retailers in prime locations can pay $50 to $200 per square foot. This creates a fascinating economic dynamic. The anchors bring the customers, but the small retailers pay the bills. Let me give you a real-world example. Aventura Mall in Florida cost approximately $200 million to build and expand. It generates over $640 in sales per square foot annually. That's more than triple the national average for shopping centers. But here's where it gets interesting. Sales per square foot doesn't equal profit per square foot. The mall owner typically collects rent, which is a percentage of those sales. Most lease agreements include a base rent plus a percentage of gross sales, usually between 6 to 8% of total sales above a certain threshold. So if Aventura Mall generates $640 per square foot in tenant sales, and the mall takes 7% of sales above the base rent, we're looking at roughly $115 per square foot in percentage rent alone. Add the base rent, and you're talking about serious revenue. But remember, this is gross revenue, not profit. Operating a mall is incredibly expensive. Utilities alone can cost $2 to $3 per square foot annually. For a 250,000 square foot mall, that's $750,000 just for electricity, water, and gas. Security costs are substantial. Insurance can run $100,000 to $200,000 annually. Property management fees range from 5 to 10% of gross revenue. Maintenance and repairs average $300,000 to $600,000 per year. And here's something that will blow your mind. The most successful malls in America have payback periods of 7 to 12 years. That means it takes nearly a decade before investors see their initial investment returned. But the question remains, what happens during those first crucial years? How do the numbers really work? Let's break down exactly where that $210 million goes. And trust me, the numbers will surprise you. Construction materials alone eat up 60% of the budget. That's $126 million just for steel, concrete, glass, and finishing materials. The contractor takes another 14%, roughly $29 million. But here's where it gets sneaky. Contractors often add indirect fees and markups worth another $2 to $3 million. Architecture and design, 19% of the total budget. We're talking $40 million for blueprints and planning. That's more than most people will earn in their entire lifetime, just for the plans. Now here's something most investors don't factor in initially: parking infrastructure. You need approximately 1 acre of parking for every 15,000 square feet of retail space. Our 250,000 square foot mall needs parking for about 1,250 cars. At $3,000 to $5,000 per parking space, that's another $5 million minimum. But let's talk about what really determines success or failure: the tenant mix. Anchor stores like Macy's or Nordstrom typically sign 20-year leases. They pay between $8 to $15 per square foot annually. Sounds low, right? Here's why mall owners accept these rates. Anchor stores can occupy 80,000 to 120,000 square feet each. That's guaranteed rental income of $960,000 to $100,000 to $1.8 million per anchor store annually. Multiply by 4 anchors, and you're looking at $4 to $7 million in stable income. The real money comes from inline stores. These smaller retailers pay $30 to $200 per square foot. A 1,000 square foot boutique might pay $80,000 annually. A jewelry store in a prime location could pay $150,000 for the same space. Let's run the numbers on a typical 250,000 square foot mall. 4 anchor stores occupy 400,000 square feet total. That leaves 150,000 square feet for inline retailers and common areas. If 100,000 square feet is leasable to inline stores at an average $60 per square foot, that's $6 million annually from small retailers alone. Add the anchor store revenue, and we're looking at $10 to $13 million in base rent annually. But remember, most leases include percentage rent. When stores hit certain sales thresholds, the mall gets a cut, usually 6 to 8% of gross sales above the breakpoint. Here's a real example from Mall at Millenia in Orlando. This 1.2 million square foot mall generates over $1,000 in sales per square foot. That's $1.2 billion in total tenant sales annually. If the mall collects 7% percentage rent on sales above base rent thresholds, we're talking about tens of millions in additional revenue. But now comes the reality check. Operating expenses are absolutely brutal. Property taxes alone can hit 2 to 4% of the property value annually. On a $210 million investment, that's $4 to $8 million per year, just in taxes. Utilities are the silent killer. A 250,000 square foot mall consumes massive amounts of energy. Air conditioning, heating, lighting, escalators, fountains, security systems. We're talking $600,000 to $750,000 annually just for electricity. Water and gas add another $150,000 to $200,000. Security is non-negotiable. 24/7 security personnel, surveillance systems, emergency response. Budget $400,000 to $600,000 annually. Maintenance is where things get expensive fast. Escalator maintenance alone costs $50,000 to $75,000 per year per escalator. Our mall might have 8 to 12 escalators. That's $600,000 just for moving stairs. Common area maintenance includes cleaning, landscaping, lighting replacement, HVAC repairs. Budget $1.50 to $3 per square foot annually. For 250,000 square feet, that's $375,000 to $750,000. Insurance is substantial. General liability, property insurance, umbrella policies, $150,000 to $300,000 annually for comprehensive coverage. Marketing and advertising expenses to attract shoppers. Successful malls spend 1 to 3% of gross revenue on marketing. If your mall generates $15 million in rental income, that's $450,000 in marketing costs. Property management fees range from 5 to 10% of gross revenue. On $15 million in annual revenue, that's $750,000 to $1.5 million. Let's add this up. Total annual operating expenses can easily hit $6 to $10 million. So if your mall generates $15 million in rental revenue, your net operating income is $5 to $9 million annually. Remember, we invested $210 million. At $7 million annual profit, the simple payback period is 30 years. At $9 million annual profit, it's 23 years. But wait, these numbers assume full occupancy from day one. That never happens. Most malls take 2 to 5 years to reach 90% occupancy. During the lease-up period, revenue is significantly lower. Meanwhile, all those operating expenses continue. So how do the most successful malls achieve payback periods of 7 to 12 years? The secret lies in something most people never consider. The secret is something called revenue diversification, and it completely changes the payback equation. Most people think malls only make money from rent. That's wrong. The smartest mall operators have discovered multiple revenue streams that can double or triple their annual income. Let's start with parking revenue. Remember those 1,250 parking spaces we calculated? In prime locations, malls charge $2 to $5 per hour for parking. During peak shopping periods, those spaces turn over 3 to 4 times per day. That's $7,500 to $25,000 in parking revenue daily during busy periods. Multiply by 100 busy days per year, and you're looking at $750,000 to $2.5 million annually, just from parking. But here's where it gets really interesting. Advertising revenue. Those massive digital displays you see in malls? They're gold mines. Prime digital billboard space in a high-traffic mall rents for $5,000 to $15,000 per month. A mall with 20 digital advertising spaces can generate $1.2 to $3.6 million annually. Directory advertising, escalator wraps, floor graphics, even bathroom stall advertisements. Successful malls treat every surface as potential revenue. The Mall of America generates over $2 million annually just from advertising. Then there's event revenue. Fashion shows, product launches, seasonal celebrations. Malls charge $10,000 to $50,000 per event for space rental. A busy mall hosting 50 events annually can generate $2.5 million. Food court revenue is particularly lucrative. Unlike traditional retailers, food vendors often pay higher base rents, plus percentage rents of 8 to 12% of gross sales. A successful food court can generate $150 to $300 per square foot annually. That's double the revenue of typical retail space. Now let's talk about the game changer, mixed-use development. The most successful modern malls aren't just retail, they're lifestyle destinations. Office towers, residential apartments, hotels, entertainment venues. Take Scottsdale Fashion Square in Arizona. It includes luxury residential towers above the retail space. Those apartments rent for $2,000 to $4,000 per month. 100 luxury units generating $3,000 average monthly rent. That's $3.6 million annually from residential alone. Office space above retail commands premium rents, $25 to $50 per square foot annually. A 100,000 square foot office component generates $2.5 to $5 million annually. Hotels integrated into mall complexes are revenue powerhouses. A 200-room hotel averaging $150 per night at 70% occupancy. That's $7.7 million annually. But here's the real secret weapon: financing strategies that reduce the actual cash investment. Most mall developers don't invest $210 million of their own money. They use a combination of debt and equity financing, typically 70 to 80% debt, 20 to 30% equity. So instead of investing $210 million, they might invest $50 to $60 million in equity. The rest is financed through construction loans, permanent mortgages, and investor partnerships. This dramatically changes the payback calculation. If you only invested $50 million of your own money, and the property generates $15 million annually after debt service, your payback period drops to 3 to 4 years. Let's look at a real success story. Westfield Garden State Plaza in New Jersey. This 2 million square foot mall cost approximately $180 million to develop and expand. It generates over $700 in sales per square foot. With smart financing and revenue diversification, the payback period was under 8 years. Here's how the math works for a well-diversified mall. Base rental income, $12 million annually. Percentage rent from high-performing tenants, $3 million. Parking revenue, $1.5 million. Advertising revenue, $2 million. Food court premium rents, $1 million. Event and specialty revenue, $500,000. Mixed-use components, office.residential, $4 million. Total annual revenue, $24 million. Operating expenses, $8 million. Net operating income, $16 million. After debt service on $150 million in loans at 6% interest, $10 million. Cash flow to equity investors, $6 million annually. With $60 million in equity investment, the payback period is 10 years. But remember, this assumes steady-state operations. The first 3 years are always challenging. Lease-up periods, lower occupancy, marketing costs to establish the mall. Year 1 might generate only 60% of projected revenue. Year 2 might hit 80%. Year 3 could reach 95% of projections. This is why location is absolutely critical. Malls in dense, affluent areas with household incomes above $75,000 perform significantly better. They reach stabilized occupancy faster and command higher rents. Population density matters too. Successful regional malls need a trade area with at least 150,000 people within a 15-minute drive. Super regional malls require 300,000 people within 20 minutes. Demographics are crucial. The sweet spot is areas with high household incomes, younger demographics, and growing populations. These areas support higher sales per square foot and faster lease-up periods. But even with perfect demographics and smart revenue diversification, there's one factor that can make or break the entire investment, something that separates the winners from the losers. And it's probably not what you think. The make or break factor is timing. Not just when you build, but when you exit. Here's what the most successful mall investors understand. The real money isn't in the annual cash flow, it's in the property appreciation and eventual sale. Let's look at the complete investment picture. A well-located, well-managed mall appreciates at 3 to 5% annually. Our $210 million mall could be worth $270 to $340 million after 10 years. That's $60 to $130 million in appreciation. Combined with 10 years of cash flow at $6 million annually, total return $120 to $190 million on a $60 million equity investment. That's a 200 to 316% total return over 10 years. Annual return $120 to $190 million on a $60 million equity investment. That's a 200 to 316% total return over 10 years. Annual return $120 to $190 million on a $60 million equity investment. That's a 200 to 316% total return over 10 years. Annual return $120 to $190 million on a $60 million equity investment. That's a 200 to 316% total return over 10 years. Annual return $120 to $190 million on a $60 million equity investment. That's a 200 to 316% total return over 10 years. Annual return $120 to $190 million on a $60 million equity investment. That's a 200 to 316% total return over 10 years. Annual return $120 $120 to $190 million on a $60 million equity investment. That's a 200 to 316% total return over 10 years. Annual return, to effect, appreciates 2% annually. After 10 years, $60 million investment becomes $190 million total return. Effective payback period, 7 years considering appreciation. Scenario 2, the average performer. Good location, adequate management, market challenges. Reaches 85% occupancy by year 4. Generates $4 million annual cash flow. Property appreciates 2% annually. After 10 years, $60 million investment becomes $130 million total return. Effective payback period, 10 years. Scenario 3, the struggling mall. Poor location, economic downturn, major anchor departure. Never exceeds 70% occupancy. Generates $1 million annual cash flow. Property depreciates 2% annually. After 10 years, $60 million investment becomes $80 million total return. Effective payback period, 20+ years, if ever. This is why location selection is absolutely critical. The difference between a prime location and a marginal one can be $100 million in total returns. Successful mall investors focus on 3 key criteria: population growth, household income trends, and retail spending patterns. Areas with population growth above 2% annually perform significantly better. Growing populations mean more customers, higher sales, and stronger tenant demand. Household income growth is equally important. Areas where median household income is increasing attract better retailers. Premium brands pay higher rents and generate more percentage rent. Retail spending patterns reveal consumer behavior changes. Areas adapting to omni-channel retail, embracing experiential shopping, and integrating technology perform better. But here's the ultimate truth about mall investments. The industry is consolidating. There are too many malls chasing too few successful retailers. Since 2010, over 400 malls have closed or been repurposed. The survivors are the cream of the crop. Prime locations, exceptional management, diversified revenue streams. This creates opportunity for smart investors. The best performing malls are becoming more valuable as competition decreases. Scarcity drives premium valuations. So, to answer our original question, how long does it take to recoup a $210 million mall investment? With traditional analysis, 20 to 30 years based on cash flow alone. With smart financing, 10 to 15 years considering leveraged returns. With revenue diversification, 7 to 12 years including all income streams. With appreciation and exit strategy, 7 to 10 years for total return payback. But here's the real answer. It depends entirely on 3 factors: location, location, and location. The best malls in prime locations with smart management can achieve total returns of 15 to 20% annually. That means your money doubles every 4 to 5 years. The worst malls in declining areas might never pay back their investment. The mall business isn't about building shopping centers. It's about creating destinations that adapt to changing consumer needs. Entertainment, dining, services, experiences. The future belongs to malls that become community hubs, not just places to shop, but places to live, work, and play. Today's most successful mall investments combine retail with residential, office, hotels, and entertainment. They're mini cities that generate revenue 24 hours a day. So the next time you walk through a successful mall, remember, you're not just seeing stores, you're seeing a $210 million investment that took years of planning, brilliant execution, and perfect timing to pay off. And now you know exactly how the numbers work.